In this lesson, you are going to learn a thing or two about managing by the numbers. This is kind of an introduction to this concept, and if you take Dr. Ralph Williams' class, you'll get a lot more in depth. But we went over some background accounting stuff that hopefully gave you a good feel for the three accounting statements: the balance sheet, the income statement, and the cash flow statement. And now we want to apply some of those lessons, apply some of those concepts as well. So to use the actual statements, but also use some of the ideas from those statements that we talked about and make better, make good management decisions by the numbers. All right. So we're going to start off by talking about financial ratios and doing ratio analysis. The aim of ratio analysis is to compare financial data and use that comparison to gain insights into how a business is performing. Ratio analysis is very widely used in business because it helps to answer some really key questions. Why is one business more profitable than another? What kind of returns are being earned by the owners from their investment in the business, or a business that invests in as a secondary business, as a project? How solvent is a business? That's talking about the liquidity that we talked about. How solvent is the business? That is, are we able to pay our debts when they become due? How well do we manage our assets, particularly in working capital, like inventory? Are we doing a good job managing our short-term assets? Are we doing a good job turning over our inventory? How much risk is the business incurring? Ratio analysis helps us answer all those things. Ratio analysis is essentially built around financial information from those accounting statements that we've already looked at. The two main sources of information that we'll be looking at are the income statements, which again is a historical record of the income and the cost of a business over time, and also the balance sheet, which you'll remember is a snapshot of all of the assets, liabilities, and equity of a business at a particular time. Who uses ratios? Well, of course, owners and outside investors who want to figure out the rate of return on their investment are going to use them. If you're a competitor, you're certainly interested in the profitability ratios of yourself and your key competitors. I guess as an employee, you'd be interested in what kind of returns and profits and risk situation that the business is in, to see if it's healthy, to know if you can ask for a raise, to understand your job security. The government is, of course, going to be interested in profit, particularly when it comes to understanding how much tax should be paid. Liquidity ratios are really important. That's like the current ratio. In particular, I would say that lenders, like banks, and people that you've got accounts payable, like suppliers, are interested in whether a business is able to pay its debt when those debts come due. If you're a supplier offering credit to a small business when you want to be pretty satisfied that the business will be able to pay your invoice when it comes due, is really important to you. A bank is going to look closely at your liquidity position in order to assess how much interest and principal that you would be capable of paying. So lots of different uses for the liquidity ratios. Here are the 5 pieces of information that I want you guys to be able to calculate and get a financial ratio for, a number for. The first is profitability, the return on assets. Is the business providing a good rate of return on assets? In other words, based on the size of the business on that left-hand side of the balance sheet, how much profit are we earning on that? The lower the number, that's the smaller amount of return on assets. You know, if you put your money in the stock market, for the most part, you can rely on a low, but, you know, normal, 2020 is not a normal year, return on assets. There's really not a more important question than this when it comes to determining if your business is strong or not. How does that number compare to other things that you could be doing with your money in terms of investing in assets? All right. Even more important to investors is not just return on assets, because return on assets, the formula is different, but one thing that's different about it is that it looks at the total money that's invested, the left-hand side, so liabilities and equity from the right-hand side are equal to assets. But return on equity just looks at the equity number. It ignores the debt part. So this is the amount earned on how much you and other owners have invested in the company. So that's even more directly comparable to other things you could be doing with your money. Both are important statistics. When we look at the formula, you'll see, kind of the differences there and why it's nice to look at both. Number 3, operating margin. This is the profitability of the company's operations alone. I'll give you a formula for that. Number 4, my ability to pay debt as it comes due. In other words, do I have the capacity to meet any short-term debt commitments? This is the current ratio, and I'll introduce this in a second. But basically, we compare our current assets and look at our current liabilities, and we want there to be an ability to pay off all of those current liabilities. So we want a ratio over 1, right? We want current assets to be greater than our current liabilities at the bare minimum. All right? And then the total amount of debt that your business is using. Debt is kind of a two-sided, two-edged sword. The idea with debt is that, we kind of like debt. Like if a bank told us they would give me a loan for $500,000 for my business, I'm going home excited from that. But that increases my risk position, right? I mean, they can call my dad if I don't make my money. I'm going to be in a lot of trouble if I go under with that much debt. But it also includes your leverage, right? So when you get a big loan from the bank and you add that in to your financing, right, to the right-hand side of that equation, and compare that, the number on the top to the bottom, that ratio is kind of your leverage. You want you want leverage as an investor, as a small business owner. The idea with leverage is that you're using less of your own money, less of your own investment, and more of other people's money to make profit for yourself. And so, there's a downside, there's the riskiness of it. If you talk to finance people, they'll tell you, okay, risk is not necessarily a bad thing, but I'm going to use it kind of colloquially in here and say, all right, on the negative side, there's the risk that you could lose things. On the positive side, there is the leverage that you gain from having a large amount of debt. But at any rate, we don't need to say it's necessarily good or bad, but just that it's more risky and also more leveragey when we get more debt. Here are the formulas for those things that I just told you about. The firm's profitability from assets, the ROA, is computed by looking at the income statement and getting our total assets, the value for our total assets, the total size of the business, and also looking at the balance sheet and calculating our operating profit. So we want the ratio to be large, right? We want to make a lot of profit for a small business, if that makes sense. The smaller the business is compared to the profits that you're creating, the larger the ROA will be. So it's a measure of profitability. All right. The rate of return similarly is the rate of return earned by the owners on their equity investments. The second equation for ROE, return on equity, is net profits divided by total owner's equity. All right, so we're not using operating profits as we did in the first one. We're using net profits, and the denominator is now owner's equity rather than assets. Okay, so we're using a smaller number here with our net profits than we are for our operating profits, but we're using probably a much smaller number, or potentially a smaller number for total owner's equity. And that's going to let you compare that to other things that you could be doing with your investment. All right. The next one is the operating profit margin. The formula for that is my operating profits, again, same thing I used in the ROA, but instead of dividing by assets, I'm going to be dividing by sales. So basically, for every dollar in goods sold, how much of that is profit? That's what the operating profit margin ratio tells me. And I can calculate that wholly from the income statement. All right. Number 4, so all of the first 2 are profitability. Number 4 is a ratio that concerns liquidity, all right, the current ratio. And that's just current assets divided by current liabilities. And so you're going to be looking at the balance sheet for both of those statistics. They're not going to be big entries on the balance sheet. Well, the current assets can be. Usually, both of these are going to be the subcategories, right? Current assets is a subcategory of assets. Current liabilities is a subcategory of the liabilities. We want that number to be as big as possible. We want liquidity. So assets divided by liabilities, at the very least, we want it to be greater than 1, like I said a minute ago. All right, and then finally, debt ratio. All right, debt ratio is going to be total liabilities divided by total assets. Obviously, the higher your liabilities are compared to your assets, the more risk you're in. All right, the biggest, technically, that your debt ratio can be is 1. So that's basically the idea that everything I own in the business, I paid for that with liabilities rather than equity. If there's any equity involved at all, then that number is going to sink below 1. And so that's going to tell me my risk position. So the higher that number is, the more risky of a position I'm in, but also the more leverage I have, right? I'm using somebody else's money, so that's a positive on that side. The negative is all the risk that goes with it. One of the best, smartest ways you can use financial ratios is to compare those to the industry average ratio, right? So you compare your return on assets to whatever the industry average is. Or you can use the industry median, the 75th percentile, whatever that you think is a good baseline for you to try to measure yourself against. I went online and found some numbers for a few years ago in the recording industry for 4 of the assets that we're talking about. 4 of the ratios that we're talking about: ROA, ROE, current ratio, and debt ratio. And I've got those listed on this slide. I've got the 75th percentile, the median, and the 25th percentile. So I'm going to give you guys some hypotheticals, and you can pause the video, and this is really very, very, very straightforward and simple, but this is how you would use it. You calculate your ratios, and then you compare them to the industry average and see, how am I doing? All right, so the first one, suppose you had an ROA of 3%. All right, these are decimals right here, so they're, you can convert those into percent. So 75th percentile is 8%, the median is 4.5%, the 25th percentile is 1%. So if I had a 3% ROA, how would I feel? What do you think? You can pause the video. Not very good, right? I'm below the median, unless, I'm a new business and I think, hey, I'm cool with looking at the 25th percentile. All right, what about my ROE, my net profits divided by the total owner's equity? Let's say that my ROE is, let's say it's 0.1. How do I feel about that? Probably good chance that my ROA is probably not going to be 0.03, and then my ROE is going to be 0.1 or 10%. If it's 10%, then it's what? It's above the median, right? Because, I'm just looking at it, the median's 6%, I'm at 10%, I'm somewhere between the 50th percentile and the 75th percentile. So, maybe I am a lot happier with such a number. All right, let's say that my current ratio is 1.4. How do I feel about that? I'm actually pretty happy with that, right? My current ratio is now, well above the median. It's close to the 75th percentile. All right. And what about my debt ratio? Let's say my debt ratio is 1.3. How do I feel about that? Well, do I feel bad or do I just feel antsy? Really, you shouldn't say you're sad about that. You're just kind of more nervous about that because you've got a debt ratio that is below the median. You're worse than most teams in terms of a high debt ratio. Most teams, most small businesses in terms of a debt ratio. So you're lower on the way this is scaled, but you've also got more leverage, right? And so I look at my debt ratio and say, hey, I'm really leveraged out there a lot. I'm nervous, but at the same time, I'm kind of excited. I've got this, I've got debt in my business, and so I can use that knowledge and at least have an understanding that my investment relative to the size of my business compared to what most people in the recording industry are doing is very low. In other words, I've got more bank financing or debt financing than most other recording industry businesses have. And that might make me a little bit excited / nervous about the future, right? It's a risky position to be in, but there can be some upside. Here's an opportunity for you to do this on your own. So compare the ratios from Dickey & Associates to the industry norms and come up with a conclusion. How are they doing on ROA? How are they doing on current ratio? How are they doing on debt ratio? How are they doing on return on equity compared to others, the typical norm in their industry?